There's a particular kind of silence that settles over a person the first time they watch a significant portion of their savings simply vanish. Not the dramatic crash you see in movies, but the slow, grinding realization that unfolds over days or weeks as numbers on a screen steadily decline. You refresh the page hoping for a mistake. You calculate and recalculate as if the arithmetic might somehow change. And then comes that hollow feeling in your chest, that quiet panic that wakes you at 3 a.m, wondering how you could have been so foolish, so blind, so utterly wrong about something that seemed so certain just weeks before. I've seen the silence in the eyes of countless investors over the decades. I've felt it myself long ago when I was young and thought I understood more than I did. It's not really about the money, not entirely. It's about the betrayal of your own judgment, the sudden fragility of plans you'd built in your mind, the embarrassment of having to admit to yourself that you didn't know what you thought you knew. And in that silence, in that uncomfortable space between what you expected and what actually happened, something important begins, though most people don't recognize it at the time. The financial markets have a peculiar way of teaching. They're not like a classroom where lessons are presented in logical order, building one upon another until mastery is achieved. No, the market teaches backwards. It gives the test first, again and again, and only afterward, sometimes years afterward, do you begin to understand what the questions were really asking. You can read every book ever written about investing. You can study charts until your eyes blur. You can listen to the smartest people explain their strategies in perfect detail. And none of it, not one word of it, will truly penetrate your understanding until you've sat with real money at risk and watched it disappear. This isn't a flaw in the educational materials. It's something deeper about human nature. We are not creatures who learn from observation alone, not when it comes to the things that really matter. We learn from consequence. We learn from pain. We learn when the abstract becomes unbearably concrete, when the hypothetical becomes the actual, when someone else's cautionary tale becomes our own lived experience. I've watched this pattern repeat itself for more than 6 decades now. A person hears about an opportunity. Maybe it's a company that seems to be changing the world. Maybe it's a trend that everyone around them is profiting from. Maybe it's just a tip from someone who sounded confident, who seemed to know something. The details don't matter much because the psychology is always the same. In the beginning, there's excitement. The numbers are moving in the right direction. The person checks their account frequently, feels a little surge of satisfaction each time, starts to believe they figured something out that others have missed. They begin to feel smarter than they did before. They start to think in terms of what they'll do with the profits. They might even tell a few people about their success, carefully casual, as if it's no big deal, as if they've been doing this sort of thing for years. And then something shifts. Maybe it's a bad earnings report. Maybe it's a change in sentiment that seems to come from nowhere. Maybe it's just the inexplicable way markets sometimes move, like a tide going out slowly at first, then faster. The excitement turns to concern. The concern turns to worry. The worry turns to fear. And fear, unchecked, turns into panic. This is where the real lesson begins, though it doesn't feel like a lesson at the time. It feels like disaster. The person who was checking their account with satisfaction is now checking it with dread. They start to search for reassurance, reading articles that confirm what they want to believe, avoiding the ones that don't. They tell themselves it's temporary, that things will turn around, that they just need to be patient, but a different kind of patience is required than the one they're practicing. They're not patiently waiting for a sound investment to compound over time. They're desperately hoping for a rescue, for the market to undo its judgment, to prove that their decision wasn't wrong after all. Days pass, weeks pass, the losses deepen, and eventually, in a moment of capitulation that feels both like relief and defeat, they sell. They lock in the loss. They tell themselves they're being smart, cutting their losses, that this is what disciplined investors do. Sometimes that's true. Often it's not. Often they're simply exhausted by the emotional weight of being wrong, and selling feels like the only way to make the pain stop. Now, here's what most people don't realize in that moment. The market wasn't trying to hurt them. The market doesn't know they exist. The market was simply doing what it always does, moving based on millions of decisions made by millions of participants, each with their own information, their own fears, their own greed, their own time horizons. What feels personal is completely impersonal. But something personal did happen. A price was paid, not just in dollars, but in confidence, in certainty, in the comfortable feeling of being in control. And this price, this tuition, as I've come to think of it, purchases something valuable if the person is willing to collect it. It purchases the beginning of wisdom. The lessons the market teaches through loss are not the ones people expect. They assume they're learning which investments to avoid, which sectors are dangerous, which patterns signal trouble. Those might be useful things to know, but they're not the important lessons. The important lessons are about yourself, about how you respond to uncertainty, about the gap between your rational plans and your emotional reactions, about the difference between confidence and overconfidence, between patience and stubbornness, between caution and paralysis. These lessons cannot be taught in the abstract. I could tell you that greed clouds judgment, and you would nod and agree and think you understood, but until you've felt the grip of greed yourself, until you've experienced that intoxicating certainty that you've found something special, that voice in your head insisting you should invest more, risk more, because the opportunity is too good to miss. You don't really know what greed feels like. You don't know how it disguises itself as insight, as conviction, as courage, and you don't know how quickly it can turn into its opposite when things go wrong. Fear is the same way. Everyone knows that fear causes bad decisions. Everyone agrees that panic selling is a mistake. But knowing this intellectually and recognizing fear when it has its hands around your throat are entirely different things. Fear doesn't announce itself as fear. It arrives dressed as prudence, as realism, as a sudden clarity about risk that you should have seen earlier. It tells you that the smart thing, the responsible thing, is to get out now before things get worse. It fills your mind with scenarios of total loss, of catastrophe, of permanent damage to your financial future. And in that state, what felt like conviction a few months ago now feels like foolishness. What felt like patience now feels like denial. The exact same investment that you researched and believed in becomes something you need to escape from. This is fear teaching its lesson. The lesson is not that you should never feel fear. The lesson is that fear, like greed, cannot be trusted to guide your decisions. Both emotions are real, both are powerful, and both will lead you astray if you follow them blindly. I've noticed over the years that there are really two types of people who lose money in the market. The first type loses money and quits. They walk away bitter, convinced that investing is a rigged game, that it's all just gambling, that the little guy never had a chance anyway. They tell themselves they were smart to get out when they did, even as they nurse the wound of their losses for years afterward. They become cynical, suspicious of anyone who claims to have found success in the market, eager to explain why it's all luck or manipulation or timing. And in a way, they're protecting themselves. If the market is impossible to understand, if success is random, then their loss wasn't really their fault. It was just bad luck. They were victims of forces beyond their control. This narrative is comforting, but it's also expensive. It costs them every opportunity they'll have in the future. It ensures that their loss was just a loss, nothing more. Tuition paid for a class they never attended. The second type of person loses money and gets quiet. They don't quit, but they also don't rush back in. They sit with the discomfort of having been wrong. They resist the urge to either blame the market or blame themselves entirely. Instead, they start to ask different questions. Not why did this happen to me, but what did I miss? Not how can I make it back quickly, but what was I thinking when I made that decision? They review their process. They identify the moment when excitement overrode analysis, or when they ignored warning signs because acknowledging them would have meant admitting doubt. They recognize the stories they told themselves, the assumptions they never questioned, the certainty they felt that wasn't based on anything solid. This kind of reflection is uncomfortable. It requires honesty that most people don't want to extend to themselves. It's much easier to move on, to distract yourself, to focus on the next opportunity. But the people who sit with their losses, who really examine them, who let the experience change them, these are the people who eventually become good investors. Not because they learn to avoid all mistakes, that's impossible, but because they learn to make fewer mistakes, smaller mistakes, and most importantly, different mistakes. You see, the market's greatest gift is not the money it can provide to those who invest wisely. Its greatest gift is the way it reveals character, particularly your own character to yourself. In most areas of life, you can hide your weaknesses, rationalize your flaws, blame circumstances or other people when things go wrong. The market doesn't allow this. It's a mirror that reflects back exactly what you bring to it. If you're impatient, the market will punish your impatience. If you're greedy, the market will punish your greed. If you're reckless or fearful or overconfident or rigid, the market will find that weakness and press against it until either you change or you break. And the tuition for these lessons is measured in dollars, which makes them impossible to ignore or explain away. The statement arrives. The numbers are what they are. You paid whether you wanted to or not. The only question is whether you learned anything worth the price. I've seen remarkable transformations over the years. People who were impulsive becoming patient. People who were arrogant becoming humble. People who thought investing was about being smart learning that it's more about being sensible. These transformations never happen through success. Success teaches you to do more of what you're already doing. Success confirms your existing beliefs and methods. Success feels good, but it doesn't penetrate very deep. Loss penetrates. Loss gets your attention in a way that profit never does. And if you let it, loss will teach you things about discipline and risk and time horizon that you could never learn any other way. I think of a friend from many years ago, someone with a brilliant mind who jumped into the market convinced that his intelligence would translate directly into investing success. He did well at first, which only reinforced his confidence. He started taking larger positions, moving quickly from one opportunity to the next, certain that he could see things others missed. And then he hit a rough patch. Several investments went wrong in succession. The losses mounted. His confidence cracked. I watched him struggle with it, watched him go through anger and denial and eventually a kind of stunned humility. He didn't quit, but he changed completely. He slowed down. He became cautious to the point where I worried he might be too cautious. But over time, he found a balance. He learned to separate what he knew from what he thought he knew. He learned to acknowledge uncertainty without being paralyzed by it. He learned to be comfortable with missing opportunities because he wasn't sure enough rather than jumping at everything that looked promising. The man who emerged from that experience was a fundamentally better investor, not because he was smarter, but because he had paid the price for self-knowledge. There's a particular kind of investor I've learned to recognize over the decades. They're not the loudest voices. They don't brag about their returns or predict where the market is heading. They don't have exciting stories about the big wins they made by being bold or clever. Instead, they have a kind of quiet confidence that comes from having survived their own mistakes. They've been humbled. They've lost money in ways that taught them something important. They've sat through downturns without panicking, not because they're braver than others, but because they've learned through hard experience that panic is expensive. They've missed opportunities they wish they'd taken, and they've taken opportunities they wish they'd missed. And the cumulative effect of all this experience is a kind of balanced judgment that can't be rushed or shortcut. They understand that investing is not about being right. It's about being approximately right often enough and very wrong infrequently enough that time and compounding can work in your favor. They understand that the game is long, that this year's returns matter far less than the average returns over decades, that preservation of capital is not cowardice but wisdom. None of these insights came from reading or studying. They came from paying attention to the cost of not understanding them. What people rarely grasp until they've lost money is how much of investing is about controlling yourself rather than analyzing companies. You can have perfect information, flawless analysis, and still fail completely if you can't manage your own behavior. The math of investing is simple. Buy good businesses at reasonable prices and hold them long enough for their value to compound. But the psychology of investing is treacherous. It requires you to be calm when others are excited, to be optimistic when others are fearful, to be patient when everything in your brain is screaming for action. It requires you to ignore the daily noise of market movements, the opinions of experts, the performance of others, the fear of missing out, the fear of losing more. It requires you to have a plan and stick to it even when the plan seems foolish, even when everyone around you is doing something different, even when your own emotions are telling you to abandon the plan and do something, anything, to make the discomfort stop. These requirements are not natural to human beings. We are built for action, for response to threat, for following the crowd, for learning from immediate consequences. The patient, long-term, contrarian behavior that leads to investing success runs counter to our instincts. And the only way most people ever develop the ability to override those instincts is by learning through painful experience that following them is more expensive than resisting them. I've thought a lot over the years about why some people learn from losses and others don't. It's not about intelligence. Some of the smartest people I've known were the worst at learning from their investing mistakes because their intelligence gave them too many ways to explain away the losses, to construct narratives where they were still right, even though they'd lost money. It's not about education or experience in other fields. I've seen successful business people who built companies and managed large organizations, completely fail at investing because the skills that made them successful in business, particularly the bias toward action and the confidence in their own judgment, worked against them in the market. What separates those who learn from those who don't seems to be something more fundamental. It's a certain kind of honesty, a willingness to admit when you're wrong without making excuses. It's intellectual humility, the understanding that the world is complex and uncertain, and that your understanding of it is always incomplete. It's emotional resilience, the ability to experience loss without being destroyed by it, to feel the pain without letting the pain drive your next decision. And perhaps most importantly, it's a long-term orientation, a genuine comfort with delayed gratification, with planting trees whose shade you'll sit under many years from now. The market will test these qualities in you. It will offer you opportunities to be greedy when greed feels like wisdom. It will terrify you into selling when holding is the right choice. It will bore you into trading when patience is the right choice. It will tempt you with stories of others getting rich quickly while you're plodding along slowly. It will make you feel foolish for being conservative, for missing out, for not being aggressive enough. And then it will reverse, and suddenly the aggressive people will look foolish and the conservative people will look wise. And then it will reverse again. This is not a bug in the market. This is the market working exactly as it's designed to work, reflecting the collective hopes and fears and greed and anxiety of millions of participants, each making decisions based on incomplete information and emotional states that change by the hour. And your job, your only job really, is to not let any of this move you from your path, to stay rational when others are losing their rationality, to stay humble when success tempts you toward arrogance, to stay patient when impatience promises faster results. And the only way you develop this ability is by failing at it repeatedly, painfully, expensively, until the lessons finally sink in deep enough to change your behavior. I think about the younger version of myself sometimes, the person I was when I first started investing. I thought I was being careful and rational. I thought I understood risk. I thought I had learned from studying the mistakes of others. And in some ways I had, but the real lessons came later, after I'd made my own mistakes, after I'd been humbled by being wrong about things I was certain about. Those experiences changed me in ways that no amount of studying could have. They gave me a healthy respect for uncertainty, for the limits of my own knowledge, for the gap between what seems obvious in hindsight and what's knowable in the present moment. They taught me that the most dangerous moment in investing is when you're certain, when doubt has completely disappeared, when an opportunity seems so clear that questioning it feels like overthinking. That certainty is a warning sign. It means you've stopped considering what you might be missing. It means you've confused a story you find compelling with reality. It means you're vulnerable. The beautiful irony of all this is that loss, the thing every investor fears and tries to avoid, is actually the mechanism by which most people become good investors. Not loss itself, but the willingness to learn from loss, to let it change you rather than just hurt you. This is why I've always said that the market is the most expensive teacher you'll ever have, but also the most effective. It charges real money for its lessons, and it doesn't grade on a curve, and it will keep teaching you the same lesson over and over at increasing cost until you finally learn it. But once you learn, really learn, not just intellectually, but in your bones, the market becomes something different. It stops being this frightening, unpredictable force and becomes simply what it is, a mechanism for allocating capital, a place where patient people with discipline and good judgment can slowly build wealth over time by participating in the growth of good businesses. The market doesn't change. You change. And that change, that transformation from someone who reacts emotionally to market movements to someone who can stay calm and rational and patient through all of it, that change is purchased with losses. So when I look at someone who has just lost money in the market, someone sitting in that particular silence I described at the beginning, feeling foolish and hurt and uncertain, I don't see failure. I see tuition being paid. I see the beginning of an education that might, if they approach it right, turn them into a successful investor over the long term. The loss is painful, but the pain is the point. It's what makes the lesson memorable. It's what forces the change that success never would. And years from now, if they stick with it, if they learn what the market is trying to teach them, they'll look back on that loss, not with bitterness, but with a kind of grudging gratitude. They'll recognize it as the moment when they started to understand, really understand, what investing is actually about. Not about being smart or lucky or bold, about being patient and disciplined and honest with yourself, about controlling your emotions rather than being controlled by them, about making fewer mistakes than the next person and smaller mistakes and recovering from mistakes faster, about playing a long game in a world obsessed with short-term results. These are lessons you cannot learn until you've paid for them. The market accepts no other form of payment. And once you've paid, once you've really learned, you join a small group of people who have figured out that the secret to investing success is not complicated. It's just very, very difficult. And the difficulty is in yourself, not in the market. The market was always just the mirror. The real work was always in learning to see yourself clearly in that reflection and in being willing to change what you see.